Thomas Curry is the founder of SOAR, a new platform rethinking how crypto projects and early-stage startups raise capital and how token holders get real economic rights. Instead of buybacks or vague governance promises, SOAR experiments with token issuance as senior debt, creating clearer claims on value while preserving founder autonomy. Today, we're going to dive into capital formation, token holder rights, and why crypto needs better financial primitives.
As a founder, do I go and sell 80%, 90% of my company on day one? Of course not. In token world, we do. You give out tokens like they're candy, and then you wonder why the founder has no incentive to keep working on this business. It's because they own a minority of their tokens, right? I would say something like to the effect of 95% of tokens out there are really just companies. Like, they're not networks, they're not anything else, they're just companies.
What probably the biggest problem is this lack of unification between equity and tokens, lack of token holder rights. And I'm very glad you guys are taking a novel approach here and trying to do something big. Okay, well, Tom, thanks for joining me here today on the Proof of Coverage podcast. Excited to dive into everything you're building, especially SOAR. But before we do that, I want to ask some more interesting, fun questions. So first off, is there a story behind your Twitter profile picture? 'Cause I thought it was interesting and different.
Yeah, so one of I would call him our CMO, is a guy named Andrew Saunders, who worked with Amazon Alexa. He worked with Hashflow, a couple of really large Web3 companies as well. We really wanted to go for this all-inclusive type of branding package. So part of the captain portion of that, Beef is an old nickname of mine from when I was a kid. And we wanted to keep it all-inclusive and kind of keep the brand together as much as possible. So we like to do the flight kind of jokes and things like that around the brand.
That's cool. No, I really like it. I think immediately was drawn to the branding.
Appreciate it.
On the Twitter and the website, it's very clean, very cohesive, including having the founders, profile picture fit almost as like a mascot, which is cool. And actually a couple of people, including one team member of mine that I told about this podcast, showed some of the materials to immediately they were like, oh, the branding's sick. The branding's cool.
Appreciate it.
And me and Proof of Coverage is the media company I started. Like, we're in the media design aesthetic kind of world. So whenever we see something that stands out and looks really great, especially in crypto, it's we got to acknowledge it for sure.
There's some pretty rough branding out here, to be honest with you. And a lot of the same, like, we were trying to think of something that when we were doing it originally, like, obviously there's like, soaring, flying, it sounds cool. But the idea behind it is let's go into something. We're used to like space and crypto. We're used to a couple different things that we constantly go back to. Let's stick out, right? Like, let's pick something that's kind of unique. No one talks about. We like planes. I thought it all fit together and it was very cohesive. Yeah. Appreciate it.
Yeah, for sure. And before we jump into SOAR and what you're building specifically, would just love to touch on your background real quick. So I saw you got a couple exits in the past. You also used to practice law, still are a licensed lawyer, I think. So curious, just like quickly on the background, how did you arrive as founder of SOAR here?
So I was an econ major, went to law school, got into law school, very quickly realized that this was probably not the path for me. Founded a marketplace in law school to pay some bills, trying to just make some ends meet. And that marketplace ended up turning into did a couple $100 million in volume over the course of a couple of years, about 200,000 customers. That got acquired in 2021, I believe. So I was very happy with that. Realized that kind of marketplaces were my calling. I love the idea of supply and demand side. Like I said, econ background before that. Still licensed, practiced, did a lot of startup advising on the side. Unfortunately, I was really bad about collecting fees, to be honest with you. Like, I could never get my money out of people. I always just enjoyed the passion of doing it and helping founders for the first time. And yeah, I mean, that all kind of culminated into building out SOAR, right? It's a marketplace by definition. We have buyers and sellers. The sellers are the companies. The buyers are the people that are trading these companies. I love it because it's a mix of, I would call it light venture capital, paired with trying to build out a demand side and giving people access to startups. So very passionate about it.
Super cool. Yeah. Well, let's I guess give our listeners the backstory here real quick. So we met about a week ago on crypto Twitter, which is how many great things get started. Token buybacks have been taking over the timeline. A lot of founders are starting to do them. A lot of founders are stopping. token buybacks. There's a lot of debate about are they good or not. And then, so I personally started to do more of a deep dive on like, well, why are token buybacks even a thing in the first place, right? Do they really compare to stock buybacks or not? What about crypto structurally has created this phenomenon? And from Proof of Coverage in collaboration with Artemis, which is a data dashboard company, and Novora, which is a crypto advisory firm, we're actually launching like a investor relations product for crypto pretty soon here. So yeah, I thought it made sense to like really understand what was going on currently in terms of token buybacks and all this stuff. And we've actually been talking to the Meteora folks too, which I know they're considering launching on SOAR, which I think would be awesome. So I think you commented something to the effect of like SOAR fixes this, right? With some interesting docs. And that's all we needed. Looked into those, thought the model was super novel. Have not heard of anyone else, thinking about the unification of equity and tokens like you guys are. So maybe before we dive into like kind of like the functionality and your solution, what's your opinion on why token buybacks became so popular in crypto? And also maybe as a part two, like why are they so hotly debated as of late?
Totally. So our team's view, and kind of from a lot of research we've done and a lot of thinking about it, right? I believe that when crypto was early, we had the idea of kind of network tokens, right? So you had Ethereum, obviously Solana a little bit later. Network tokens, I do put in like their own basket, right? Because like owning a piece of Solana versus owning a piece of Solana's block space, I think are two radically different things, right? And I think it's very cool that for Ethereum, for Solana, in different ways, there's value that accrues back to the actual network token. What happened after that is not everything is a network, right? It's not an L1. We had some L2s and things like that, but the reality is that there's a lot of other apps out there. I would say something like to the effect of 95% of tokens out there are really just companies. Like they're not networks, they're not anything else, they're just companies, right? And kind of what we started looking at is that obviously you had Gary Gensler and you had the SEC that was cracking down very heavily on tokens and trying to segregate the idea of a token, an equity, or a security, right? And unfortunately, in that world of splitting these two things separately, rather than protecting consumers, they burned everyone, right? So how I view buybacks and how they actually became a thing is the reality is we've gotten to the point where people got more comfortable, realized that these tokens are accruing no value whatsoever. And rather than giving up value in the company, they said, well, we'll give you access to the network flows or to the product flows, right? So the cash flow of the underlying business. Unfortunately, we're seeing it very quickly with Helium, Jupe. Met has talked about buybacks a lot. The reality is that there's so many negatives to buybacks that are now kind of coming to the surface, right? I mean, number one is price action. Besides Hyperliquid, really no token that's done buybacks has actually performed well. Jupe's done, I think, $70 million in buybacks. The token's down, 80%, right? It's unfortunate, but the reality is that there's a bigger problem here. I'll let you kind of keep on your path, but I'm sure we'll touch on it.
100%. Yeah, I mean, I called token buybacks a Band-Aid on a bullet hole recently in a piece I wrote. Yeah, because I was just thinking of like, how to conceptualize or communicate like why token buybacks are a thing, and that I think very vividly paints the picture of what's going on, right? Is like because of the lawfare that was going on, there were a lot of crypto projects launched with both equity and tokens. So then you don't really know where the value is accruing, right? The revenue comes in and hits a bank account. Like it's only going to go to the token if the token holders really have almost like equity-like rights in the whole company, and they didn't. So there was that. Those like dual entity structures. There's, I guess the continuation of that thought is like tokens are an equity. They're not the same. They don't have the same financial and legal protections. And then, what's so popular in crypto is token incentives for this and that and for growth. And that's great. But a way to counter them is like to buy back the token. And so because of all those reasons, buybacks have become popular. Let's talk about SOAR and your approach to this. Like maybe to start off, like how did you even come up with the idea, right? Because I do think it's very novel. And then maybe let's go through how it works in practice.
One of our other team members is also an attorney. I've been thinking about this problem since I got into crypto, right? 2018, I thought we were building the future of finance. Little did I know that I was actually going to be spending most of my time trading memes. Shout out to the blockchain. it's an addicting space. I think that we've gotten to the point where we're all trying to figure out, like, market downturns, stock market's at all-time high. Like, where's the liquidity? Why is there no liquidity flowing into this market, right? And we started with looking at like things like obviously Pump Fund. There were some good projects in 2024 in December of 24 where there was some cool AI stuff that launched, right? And, you know, kind of knew at the time, like, this is all a joke, but like it was fun to trade at the time. The reality is that there were a couple things that I thought were quite novel. Unfortunately, I was just buying a meme coin, right? I was just buying a token that was loosely correlated with the business. Believe comes out obviously early last year. You start seeing these businesses pop up and you see a thirst for this stuff, right? We see a thirst for tech, I guess, for the first time in basically the whole cycle, where people are like, I really want to buy into this company because he's a great founder, good business. Like, I'd like to get access to this. Then you get down the road a little bit. And unfortunately, once again, we run into the same conundrum again. These tokens aren't equity. They're not a part of the business. I'm not getting any, you know, real benefits from holding the token outside of liquidity flows and speculation, right? So that was kind of, I would shout out Believe. Ben obviously made a horrible group of decisions, I believe, at different points. But the reality is that he did give us some inspiration to build out what SOAR is. So I appreciate that. Where we got to the legal portion of this was we started thinking about how can we solve this, right? How can we build access to startups, give people intrinsic value in these startups one way or another, right? The baseline you start with is, okay, how do we give equity, right? Equity is a security. There's a whole bunch of different problems with obviously giving out tokenized securities, especially the fact that we're seeing a lot of flows go on chain for the first time. It seems like it's progression to more trading on chain, right? Versus centralized exchanges, et cetera. We want to give anyone access to these tokens. How do we do that? The DRP structure was a mix of some thoughts about what doesn't work with tokens. So like, let's think about throwing out every idea we have of tokens and start from scratch, right? The first thing we hit on was, as a founder, do I go and sell 80%, 90% of my company on day one? Of course not, right? In token world, we do. You give out tokens like they're candy, and then you wonder why the founder has no incentive to keep working on this business. It's because they own a minority of their tokens, right? So we got to the baseline of like, the founder should retain the majority of their tokens. I think if you look at like projects like Curve, where Michael living in a mansion, good for him. But like, the reality is he wakes up every day and works on Curve. He's a great founder. Like, by all definitions, he's a great founder. We wanted to get back to giving and empowering our founders, holding the majority of your tokens, but how do we give that value back to consumers as well, right? And the idea is essentially think of it like a cap table, right? Rather than having token unlocks, investing, and these airdrops to the community and things like that, why don't we just think about it like, I'm going to do my first fundraise on chain, or I'm going to tokenize my business. Let me find a structure that enables people to hold an intrinsic value in the company. Let's remove the dual token equity model and have one source of value accrual. So that was really where we started. It's continued to evolve since then. But the general idea is, equity is risky, obviously, security stuff. We like the debt mechanism because senior debt is the highest on the liquidation preference, right? From a legal preference, you'd much prefer be a senior debt holder than an equity holder. And in this world, you just talked about it earlier about like disclosures and trying to build out more transparency about these products. Unfortunately, we're not always privy to that, especially Web2 companies. The only way we can protect people is by giving them a senior position against the company that enables them to say, hey, listen, even if you dilute your equity, even if you take out a bunch of debt that is, you know, subservient to the senior debt, I don't really care because I'm first in line. I get my cash and I walk away.
100%. Yeah. So let's walk through an example of a project that is launched on SOAR kind of from start to finish. So from launch through potential sale to Coinbase or something, totally. Acquisition. And how do token holders, how are they involved? How do they play a part the whole way?
Absolutely. So I guess we'll use like CPT for example. I think that's the largest by market cap. I think that they're the most far along in terms of launches. So CPT came to us. I met Patrick Sang in New York, had a really good conversation with him. His background's incredible. Really loved him. Figured like this is our banger. This is our first launch. He wanted to democratize some access to his company. It's obviously like defense tech, drone tech, whatever you want to call it. And we thought, okay, this is a great offering. So he said, listen, I need control of my company, but I want to fundraise a little bit from the public. I want to give exposure to the public, right? So what we did for them is that they launched with about 7% of the senior debt allocated towards the public, right? So basically by launching on the bonding curve and then also the LP, you're able to get exposure to about 7% of their company at any given moment through this debt mechanism, right? They make,
and just real quick for our listeners, like I guess from my understanding, the way that that's done is that there's a total supply of tokens. That's a hard cap. It's fixed. Say it's 100 million.
It is.
And if you're, yeah, okay, nice. If you're saying there, if Patrick's saying there's 7% of my company that's up for grabs, up for investors, it's 7 million tokens out of the 100 million are minted by him for his use, but then owned by SOAR token holders because they, basically participate in that sale. Is that how it would work?
Correct. So the tokens are actually minted, put into a bonding curve for legal purposes, right? There is no direct sale from the team to token holders. It is just put into a curve. People trade against each other, right? So it's a typical bonding curve structure. That's why we like that from a legal perspective. In terms of, absolutely. You can buy into CPT. You can sell CPT at any given moment. It's a liquid vessel, right? The cool thing is that no matter what, whenever you are trading these tokens, SOAR is the intermediary that holds the senior debt against Impulsor Enterprises at any given moment, right? So what we do is we have constant contact with Patrick, with his team. We check in, obviously help them a ton on the marketing side and business side and development. But most importantly, we're building out this dashboard, I guess, if you want to call it that, whereby you can actually get very deep insights into what's going on with Impulsor. We check in with them. They actually have to sign documents that if they're fraudulent, we can actually pursue that. They're actually putting up real signatures on these documents to say, hey, listen, these are all true. We certify that these are true. Then we can pass those on to the public and enable people to get better insights, get better protections. And at the end of the day, like I said, the senior debt always is superior to any other thing on their cap stack.
Right. Okay. So basically the launch happens. There's 100 million tokens total, of which 7 million have been invested in or participated.
Put into the public,
Yeah, put into the public. And so then from there, Patrick's operating his company. What are the different options in terms of him wanting to mint more tokens, him wanting to buy back tokens? How would that affect current token holders, like kind of all the mechanics?
Yep. So the senior debt is dynamic at any given moment, right? And we're putting all this on chain at the moment as well. So we'll have a DRP announcement in the next couple of weeks whereby all this stuff is going on chain and super transparent. But how it works is essentially you start with that 7%, right? Most companies start around 7 to 10%, depending on the company. And in Patrick's case, if they were to go and buy back tokens, they're able to do so at any given moment and reduce their debt against their company, right? So it's very simple. You can have buybacks in our model. It reduces your debt. The idea of buying back every token and buying out your debt, obviously with a blockchain, is very difficult to do. But we do have mechanisms in place for companies that come to us and they say, hey, listen, I want to use this to bootstrap. I'm not sure if the token will work for us long term. I might want to get rid of it at some point. All you have to do is create an amicable outcome with your token holders at some given moment. Say, listen, we're going to put up a couple $1 million to buy out the remaining supply. Everyone's happy. They get paid out. And then you walk away from the token, right? So we give all these different options to all of our founders. In Patrick's case, down the road, it's a 3-month lockup period. You're not able to touch any tokens until then. After 3 months, what you have to do is you have to, have a discussion period with your community. Think of them like, for lack of a better term, they're basically the bank. They're able to come to you and say, hey, listen, we don't agree with this. We don't agree with this proposal. They can't say no. And I think that's important. It's founder sovereignty is something that we pitch a lot, right? I don't want people to absolutely have control over these companies. We're not looking for control right now. We're looking for participation and access and financial upside. They're able to discuss with them. Obviously, listen, if your token holders say no, don't do this, I would advise that you don't do it, to be honest with you. So you have kind of that back and forth, and then you make a final proposal to the public. It's disclosed, shown on our dashboard for 72 hours, upon which after 72 hours, you can then get those tokens sent to your wallet and use them for fundraising, OTC deals, market makers, centralized exchange listings. All of those things are justifiable reasons why you would unlock those tokens. But it was all, and like, just to go back a little bit, our model was totally built after public markets, right? We're not trying to reinvent the wheel. This is what happens when you're a CEO of a company and you're selling shares. You disclose to the public, you don't have to justify it in those situations, but in our situation, you have to justify it. And you say, this is why we're doing it. The public can react or respond appropriately before their tokens hit the open market, and then everything's fair game.
Yeah, and maybe this is me going too deep and nerding out, but like I'm just curious, are there technically two tokens we're talking about here? Like in Patrick's example, we're talking about he's minting tokens, of that are native to his project that he can then use and sell and do whatever with. But then there's also the tokens that go into the bonding curve that for the investors and token holders that maybe represent the debt on top of his company. Are those the same tokens or different?
Same token. It's just a mintable token, right? So you start with 7 million supply, and then you can mint it up to, right now our cap is 20%. So in theory, it means that you can only have a debt of 20%. That's to prevent dilution. At some point, right, you go from like fundraising from the public to actually maybe you're just a scammer and you're taking a huge debt against a company that's not worth anything.
Okay. So there's like basically one token and maybe there's like a clone of it in the bonding curve that's assigned to token holders, but then also that is given to Patrick to do whatever he needs to do with.
Yeah. I mean, like I said, it's the same contract address, right? The tokens that are put into the bonding curve are a portion of that supply. The remaining is mintable supply that he can mint at any given moment, if that makes sense.
Okay. Yeah. So yeah, because like the initial raise is 7 million out of the 100.
Correct.
So that's what token holders own. But then he can say like, oh, can I have another 5 for this reason?
Yeah.
And then,
But at any given moment, whenever he does that, right, it's no different than buybacks reduce that senior debt. Anytime you mint new tokens, it increases your senior debt. So it goes up and down based on what your supply dynamics are.
Right. And the debt is basically priced at current tokens that have been, minted or that are outstanding times current price. And so he can buy those back at any time, but the price of the debt can fluctuate.
The interesting thing about our debt mechanic, which I think a lot of people actually don't get, is that the debt mechanic is always against the underlying company, right? And the reason we do that is for example, like in Padre's case or Tensor's case, Vector, whatever. The reality is if you had a debt against just the token or the debt was represented by the value of the token, no one would really be that much better off, right? In our case, we want to make sure that there is one source of value accrual. You're always rooting for the company to succeed. You don't really have to worry about the token much, right? The token is obviously a liquid vessel for it, but the reality is you want the company to do well. In Pulsar's case, right now they have a 7% debt. If they got bought for $100 million tomorrow, $7 million of that would be directly allocated to SOAR as the private debt holder, which would then be dispersed as we see fit.
Yeah. So you covered my next question, which was like, what happens in the event of a sale, right? Like how, if token buybacks currently are the bandit on a bullet hole of like trying to force value accrual in, two token holders mechanically, and it's not great. The way that you guys do it is via this mechanism. And so, yeah, there's 100 million tokens. He's issued 7 million that are up for public grabs, and he sells his company. Basically, the investors, the token holder investors would get 7% of that.
Correct.
That outcome because they own 7% of.
It's always represented by circulating supply at any given moment. So you're circulating supply that is in the public. We're going to have a dashboard that covers all this very shortly, but you'll always see how much the debt percentage is against the actual company.
That makes sense. Do you ever see founders potentially doing a secondary or tertiary like sale or launch, like going from that 7 million to like more, right? Selling more to the public potentially?
Yeah, totally. We see it as in certain cases whereby there's a solid justification. I think it makes a lot of sense, right? And I think that I always get tied up, and I don't want to mention any names, but I always get tied up in liquid markets are really cool because of liquid, right? And that's what I love about our model is that it's a dynamic type of model whereby you can buy back and reduce, or you can increase and mint more and increase your debt, right? And I think that's great, because why have a liquid market if the founders and the team don't actually have access to it? So I do see events whereby down the road, maybe Patrick's like, hey, listen, rather than, I have two options, right? I go to either VC1, who takes a cut of it, or I raise more from the public. What would you guys prefer to do? And you can just have that conversation at the end of the day, right? We're not the end all be all for fundraising. The reality is we're primarily focused on getting companies off the ground, giving them that startup capital to find their next big raise, right? I do aspire to get towards the later stage stuff, but the reality is right now for early stage stuff, we're a great way to quickly and efficiently find capital formation and fundraise. And the later stage stuff, what we're seeing is that they're coming to us and saying, hey, I need a bridge loan. Can I tokenize through SOAR, get a quick bridge loan, and then go raise my next round? So that's kind of the two areas that we're seeing the most PMF right now.
Right. That makes sense. And then my only, I don't know, kind of like outstanding question on the model is the founder obviously is going to have knowledge about his company and business that even token holder investors will not have.
Yep.
What do you think would happen in the situation where like there's a big deal that he's about to sign and he knows is going to be very bullish for the company and the business and the valuation and revenue? Wouldn't he have an incentive to like buy back tokens, a lot of them, as many of them as he could before that deal gets announced, to the detriment of like token holders potentially?
Totally. So I think number one on that front is that we need to improve and increase transparency, right? So that's one of the big focuses of Q1 for us, is to try to get more certified documents that are presented to the public whenever it's appropriate. The second portion of that is that it's also a little bit of kind of how we designed the mechanics, right? The reality is that we want these tokens to move without, not every company gets acquired. I want these tokens to perform well over time based on how well the underlying business is. And I think that situation you described, although it can be less malicious, it's more like, hey, listen, we're making big moves. It's probably a good idea for myself to go acquire some of this debt cheap right now because I feel like we're going to have a good year. That positively affects token holders, right? So it's kind of this push and pull formula whereby the team, ideally, in a world where they have cash and they have cash flow, what you're going to see is they kind of keep the parity between the public market and the private market very close in tandem, right? Because if you're a company and you're undervalued by 50%, you might say, well, we have this free cash sitting around. We're not investing in growth right now. Let's do some buybacks. It'll make people happy, A, but most importantly, we can actually get back some of our company value cheap. Alternatively, if you're feeling like the market's running hot and you're a little bit overvalued, you'd be like Brian, from Coinbase, like, sometimes obviously any CEO says like, I need to take some of the value off the table right now. And in a company's case, you could say, well, rather than let's just let the thing run and leave it, maybe you take a little bit of value off the open market and reinvest that in growth and say like, we're not worth $200 million yet, but if we put, $1 million into growth, we can get there, right? So it's always like trying to keep it within parity. And I think that's really the goal of any market, is that it's pretty efficient, right?
Yeah, that makes sense. And obviously the founding team can buy their tokens that are circulating off the open market. Like maybe they minted some, sold them, they can buy them back at any time for the current market price. Can the founding team buy out the like initial launch investors at the current price, like without them signing off on it? Or would they have to say like, would they have to make those tokens or those shares, kind of in the company, like available to the founder?
It's a liquid market, right? Where you don't have to ever give back those tokens, right? In theory. Now, I like to think about it from a game theory perspective, right? And both sides are trying to work together to find the best outcome, right? And probably in reality, what any negotiation occurs, you kind of end up in the middle ground, right? Where not either party's like super satisfied, but they're okay with the outcome. I think in the case of, yes, like if you're a founder and you're trying to get back all of these tokens, like I talked about earlier, we are creating mechanisms for you to actually wind down your token. The reality is that token holders are going to find the best outcome for themselves and agree with that as long as they're happy with it. And the founder is going to say, great, I'm happy with this proposal that we're putting forth, right? In terms of the the later stage stuff, yes, like I said, once again, you can hold on to your tokens and prevent people from buying them back. You can always hold that value. No one can really force them out of your wallet, right? What I do think we will see as we're talking to some of these larger companies that are, like I said, they're trying to use this as a
bridge round,
right? They kind of want to walk away from this at some point. What I think you'll see is that they end up just putting a portion of their later round into an LP. They're able to buy out everyone at an agreed upon rate, and then they walk away hands clean. And I think that's good, right? I think we've gotten too obsessed with in crypto this idea of tokens are forever, right? I mean, we've seen it with like Twitter, for example. I mean, Elon bought Twitter, that was a public company, and took it back private. And I think that's how we want this market to work, the same way that you take a company public on SOAR, on Solana, wherever chain you're on, and eventually you bring it back private if you think it makes sense. It might be private equity, whoever it is. I like to think of everything about how the real world works. I want to replicate that on SOAR. And we usually take inspiration. If you understand history and understand how the world works, we're very close in time and place to all those things that occur.
For sure. And I think even on the opposite side of that, like I'm glad to hear that that's how the process works from like a token holder investor protection perspective, right? Like if I invest in the launch of Patrick's token on SOAR, those tokens are in my wallet and they represent an ownership share in the company, and he can't force them out of my wallet by just like buying them back at the market price. Like I can hold on to those for however long or short I want to. So I think that's great. Let's talk about the platform itself. So are you guys live right now? If not, when do you expect to launch? And it seems like you want to serve a lot of other verticals than just crypto. So maybe just
correct,
kind of give us the overall idea on the platform.
Yeah. So we are live. We have, I think, about 8 verified launches live currently. 3 of them are curated companies. Verified in our platform means that you are a KYC, KYB business, right? So your founder's KYC'd, the business is KYB. I think it's quite important that we get more transparency. Like I said, I always think about things as a public market. There is no founder on the NASDAQ or in the S&P or anywhere else that you don't know who the hell it is, right?
Yeah.
So I like the idea of our founders coming. We increase trust and transparency by throwing a name on it, saying, hey, this is me. This is what I'm doing. Most importantly, this legal agreement has to be formed with the company. So it only really works if there's actual company sitting there. The main, and I'll give you the broad vision of where we're going with this. I would love to say, hey, listen, we're just sticking with CT and we want to become like a Believe app. But we truly believe that our end goal is giving access to retail to participate in early stage companies. I think the OpenAI IPO is criminal. I've loved OpenAI for many years, as has a lot of my peers. The reality is I never got a chance to participate. And now I have to decide if I want to buy everyone else's bags from many rounds of VC funding, or do I want to sit down on one of the most revolutionary companies I've ever seen in my lifetime? So our goal is to find those unicorns. It's going to be slow. We understand it's a lot of work, right? But we're seeing 2 things that converge that I think really help us out. Number one, retail is getting more and more interested in, Kalshi, which is obviously financial, FanDuel, gambling, but it is what it is. But also Robinhood has really pressed the matter on giving people access to more trading. On the second portion of that, we're seeing this convergence whereby founders want more autonomy. They want to raise less money because AI is reducing how much money they need to spend on their business to get up and running, right? So we're seeing companies that raised almost no capital go to 10 million plus ARR. Our model works extremely well for those companies that need a little bit of cash to get off the ground, give you access to consumers that can be your evangelists. These people are, at the end of the day, getting access to your startup. They're participating in your startup. They are going to go around and sell you for yourself, right? Or for your company. We like the convergence of those couple things. And most importantly, kind of how I've been really building out the vision, how we're building out the product is that Product Hunt is a super cool novel idea that millions and millions of people go on, right? And a lot of products launch on. I like the idea of Product Hunt paired with the ability to actually participate rather than me just going and playing with your app. Why don't I get
Yeah.
a little bit of a stake in the app, right? Let me participate in the company. So that's kind of how my vision of what we're building right now looks like.
Love that. I mean, super exciting. I think providing access to retail investors on early stage stuff is really important. And I think you're hopefully going to unlock a lot of liquidity for those early stage founders, especially within crypto, where there's just been that liquidity has held itself back because it's been scared, because there's all these issues with structuring and ownership and everything else in crypto. So that's awesome. Last question for you is just about crypto IR, right? Or early stage startup IR. Like we talked a bit about it before, but you've been doing a lot of thinking and research and writing and building on it. So have I. Why do you think IR has been so overlooked in crypto so far? And like maybe what are the top 2 or 3 things you think crypto founders could learn from maybe how today's public companies do IR?
Yeah, the broad answer to that would be the reality is that they've never looked at token holders like IR, right? They've never cared to give them any actual insights into the business, because what did it matter? They don't have access or ownership of anything.
True. Yeah.
That's the easy answer.
They didn't need to.
Correct.
Yeah.
They didn't need to. Nowadays, we're getting smarter. You see how many people are preaching ownership. They're preaching the idea that we need to destroy this dual token equity model. It doesn't work for anyone, right? So I think that people are seeing it as, and I hate to say it, I'll be honest with you, I think there's a lot of demand for IR because number is going down. And I think you'll see a lot less demand for it as number is going up. That's kind of my first take. Like, I hate to say it, but that's just how crypto works in a lot of ways, right? Like, crypto's not a proactive group of people. We're always reactive. We're like, shit, numbers going down, let me do something. As opposed to like, how can we create a better environment for everyone to participate in? I think that what I see is kind of where we're going is I think the IR stuff that you yourself, I know some other people are really pushing heavily in this area, as are we, right? Just for our companies, not broader. But I know you guys are trying to go more broad with it, which is great. I think that pair that with ownership and the idea of actual companies tokenizing and value in the company, not value in some meme coin token that is loosely correlated with the business, is how we get this next wave of capital on chain. I think that what we're realizing is that blockchain, as we've always kind of known, is a great capital formation opportunity, right? We don't need to recreate finance in a lot of ways. And like I always tell people, like, I think we went so wrong in 2020 and 2021 when we thought we were creating these new primitives. And then I watched Stripe come and launch Tempo on their own chain. They were like, we don't really want to deal with Ethereum, right? You're never going to change. Like I hate to say it, but we're never going to change what the largest enterprises in the world are doing, right? And I take that back to equity and ownership and value in companies. That's never going to change, I don't think. I don't think that there's new creations to be had. No one in Web2 complains about equity. They don't complain about shares, right? They're happy with it. It works. Let's use the chain and use blockchain to improve capital formation, enable people to get access to things that they normally would not have access to. And I think the rest of it comes afterwards, right? The liquidity especially. So I always tell people, like, with the investor relations stuff, that's one huge step in the right direction. I think that tokens that are actually valuable and companies that are performing well is the second step. But what people always get hung up on, and I have to talk to a lot of people about it every day, is that it's not a snap like this and it gets all fixed. It doesn't get solved overnight, right? Create valuable opportunities with valuable companies and valuable tokens. The liquidity will come eventually. It's not going to come overnight. We've been stuck at the same liquidity levels outside of stable coins for like 5 years now. And I can blame it on 2 different things. Worthless ass tokens that we've all encouraged and we've all bet on, myself included, unfortunately. And I've never really got into it until now with SOAR. The second portion of that is that we've gotten to the point where now we're seeing hyperliquid buybacks. Let me ask you a question, just broad question. I've asked this to a lot of people. Would you believe that Pump is better off buying $200 million of their token back, or are they better off marketing Pump Fund and the opportunity to buy these coins to $200 million, the tune of $200 million, right? The reality is that Our best winning apps in the past 2 years have spent all of their money buying back tokens, mind you, that are worthless at the end of the day, right? They're not
That
worth
don't even
anything.
have a claim on,
They
like
have
a
no claim
permanent
on
claim
anything.
on the end. Exactly.
And rather than like market and like I said, like they're like, let me put it to you this way. OpenAI has spent $1 trillion on marketing, probably. I don't know the actual number, but they spent a lot of money on marketing, right? As has Anthropic and all these other companies. What has that done? It's grown the AI sector. It doesn't even affect OpenAI all the time. It grows the sector. In crypto, we don't spend money on marketing ourselves. And then we cry when there's no inflows of capital. The only inflows we've had this whole cycle realistically was early on, we had a little bit of retail inflow that got burned naturally because we rob every retail user always. And then the second portion of that was ETF flows, right? So there's some trickle down from the people that held Bitcoin and held Ethereum, and then they bought some other random shitcoins. But the reality is there's very little inflows, and it's because we don't market ourselves at all.
100%. Well, Tom, this is definitely one of my favorite podcasts as of late. I think just very topical, speaks to the heart of what's going on in the crypto industry today. What probably the biggest problem is, if you had to pick one big problem in crypto today, it's probably this lack of unification between equity and tokens, lack of token holder rights. And I'm very glad you guys are taking a novel approach here and trying to do something big. So where can folks find you guys on the internet? If there's a founder that wants to launch on SOAR, how can they get in touch?
Yeah, I mean, we have our main account, Launch on SOAR, is the handle. I'm Tom Curry on Twitter. I'm pretty loud and obnoxious. So if you see me around, I answer every DM. We have about 10 guys that are constantly working around the clock to try to make sure that we get companies to the right place. The other thing I'll note is that we do work with post-launch companies. Met is one of them that we're talking to right now, but we have a bunch of other ones in the pipeline. If you want to, and you're passionate about giving value back to your token holders, we can do it quickly. We can do it efficiently. It costs you no money. It's very fast. Snap like that. I can do it in a couple days. Happy to get you set up. Would love to work with anyone. I really am very passionate, and our team is very passionate about improving the opportunities in crypto. And I think we do that by improving tokens first and foremost.
100%. Well, Tom, thanks for coming on.
Thanks, Connor. I really appreciate it.